Hello, friends and family. This is Ernie Rivera. Welcome to the Finance Dojo, where we get financially fit together. As promised, I am going to do an entire video today on asset classes. We have a lot to talk about today, so get ready. This is what you don't know about asset classes, a beginner's guide to investment. So in this video, we're going to be talking about a few different asset classes, the most common ones, and we'll talk about what that means to you. Now, I can't tell you what to invest in. I'm not a financial advisor, but I will go over the information so that you have it in your back pocket so that you can do your own research so you can decide what's best for you at your level. So let's start off. We have equities, and for those who don't know what equities is, it's a fancy word for stocks. And stocks are a very popular asset class. These asset classes are going to be divided into like categories of investments, not individual investments, but categories of investments. So we have the first one's equities, and equities are just different types of stocks. A lot of people say, should I invest in individual stocks? What about this stock? It's going up really high. Or should I invest in index funds? And an index fund, if you do not recall, is just a collection of equities. It's a collection of investments, right? And it's all packaged together so that it does the thinking for you, so that your investment stays pretty level, rising up. When you invest in an individual stock, a lot of time there's a lot of volatility. It can go up, down. And the problem with investing with individual stocks, and I'm not telling you not to do this, but what I am saying is that a lot of people who are investing for the long term, they understand that all businesses go out of business eventually. So if you're investing for the long term, investing in one single stock might not work out, right? So who are individual stocks good for then, right? Well, individual stocks are usually good for people who are interested in speculating. They're interested in day trading. They're day traders or swing traders. And if you don't know what that is, look up day trader, look up swing trader, look up speculator. And what it is people who like to ride the waves of the ups and the downs, and trade on the daily, trade every couple of days, so that they get the biggest bang for their buck. That's a very advanced technique, and I wouldn't recommend it for anyone just starting out. Not that I'm here to recommend anything for you, but it's a little hard to ride, right? So we have index funds, and what an index fund is a collection of stocks. Most of the time they're trying to mirror the S&P 500, which is our guiding our ruler for excellence in the market, right? The S&P 500 is a collection of the top 500 stocks performing at any given time in the stock market. And over the past 80 years, any 10 years on average, it has doubled your money if you've kept it in. Just kept it in. So it's not bad. Again, it's a collection of the top 500 stocks in the market. The most popular S&P 500 index fund is VOO, ticker symbol VOO, and that's the Vanguard 500 index fund. You also have things like SPY, like SPY. You know, like I like for myself, I like SPYG, which is like their growth stock. It's invested in a little more growth funds. And let's talk about this, right? Because there are different types of stocks you want, right? There's some that you want them to just give you like a good daily return. There's some that you're interested in collecting on that growth. There's some that are dividend stocks. And what a dividend is, it's just a reward they give you, every few months or so. Sometimes every 6 months, every year, every 3 months, whatever it may be. It's a reward that they give you for holding their stock, because when you hold their stock, it keeps their stock prices high, and they like that. So if they have more money than they know what to do with, if they are not trying to grow their company currently, they might take some of their extra money and give you a little reward for holding their stock. Let's move on. We have fixed income or bonds, and what a bond is, it's like a really safe promise. It's like an IOU from sometimes companies, sometimes cities, sometimes states. The most safe ones being from the federal government themselves. And why do I say it's safe? It's safe because it's backed by the U.S. government, meaning that the U.S. government has to collapse for you not to get paid back for it, right? The thing is, they're going to pay you a lot less than the S&P 500 will, but it's steady, it's secure, it's really safe. A lot of people, when they get closer to retirement, decide I'm going to take my money out of stocks and put them in bonds. That's their choice because they don't want to have like a bad 10 years and like lose a lot of their money when they don't have the opportunity to get back. They're closer to retirement. Next, we have cash and cash equivalents. So, what a cash and cash equivalent is, it's just something with a lot of liquidity, right? Meaning that you can use it really quick, really easily, like cash itself, or like money sitting in a savings account, high yield savings account, or a money market account. And what a money market account is, it's basically like a savings account, but they pay you a higher percentage for putting your money in there. And why do they pay you a higher percentage? Because they are not FDIC insured, and that is the insurance of banking companies, right? So if you have your money in a savings account, right, they're insured. So like if the bank goes under, they have to pay you back. Money market account, if the bank goes under or the credit union goes under, they don't have to pay you, I don't believe, right? But it's usually pretty safe, and that's why they give you a much higher percentage for having it in a money market account. Let's keep moving on. We have real estate, and real estate can be hard to get into because it requires a large down payment, although you can have a smaller down payment. If you have a smaller down payment, anything under 20%, you can have as low as, I think, 3% if you get the right deal. The problem with that is that you want cash flow, right? You want money coming in your pocket every month, and you have to pay extra insurance if you pay anything under 20%. It's called mortgage insurance, and they make you pay that on top of the homeowner's insurance, and that's on top of any fees for like neighborhood associations or like condominium associations you may have. So make sure that you check in all the fees, your insurance and your mortgage insurance if you're not paying 20% down payment. For those of you who want to get into it a little easier, right? There are organizations where they own either rental real estate or like for like the average person living in the rentals, and they have it for commercial real estate, meaning like all your stores and whatnot, your Best Buy and this and that, they're renting it to, your Targets you're renting it to, your Walmarts they're renting it to. And what it is, it's a business, right? It's called a REIT, and it's a type of trust where basically this business just owns real estate that they rent out, right? And you basically buy a share of that REIT, and then you become a very small part owner of this company that rents out to them. So you get paid rental fees from all the companies, from all the people who are being rented to, right? The thing about REITs is, and they usually pay a pretty decent percentage, but you're also paying a manager to manage the account, right? Because they have to worry about all the real estate. So that's what they do at the REITs. Look into it. Google all this, do ChatGPT, all of this, right? It's a really interesting thing, right? So let's check it out. Let's keep going. We have commodities such as gold and silver, and we already did a video on gold and silver. I think they're excellent. I think they're really safe. I don't think they're going anywhere. The problem is they're not appreciating as quickly as things like stocks, even bonds, or real estate, excuse me. And so it's there for when things go really, really, really south. At least then you have something in your hands, and that could always be a good move. Just make sure you don't put all your money into it, because you want your money to grow and develop. So like put a few percent in there into gold, silver, copper, whatever you want to do. We have the currencies, or the foreign exchange market, right? And this is basically just trading money from one place for money for another place, like between U.S. and Japan, or Germany and whatever. And I'm gonna be honest, this is the part of the video I know the least about, so I'm gonna have you do your own research on the foreign currency market, right? Do a ChatGPT, do a Google search, right? I'm not the guy to tell you about this one specific area, so let's move on from that. We have alternative investments. Alternative investments are like private equity, like if you own your own business, if you're a owner of that business, if it's not a publicly traded company, then you have your shares of the business that you own. That's private equity. or you could have a company that is a private equity company where you go in and you buy businesses, right? And you hold them yourselves, fix them up, and you sell them to other people. And yes, people do that. Like, like people who flip houses, right? Well, these people are people flipping businesses. They find undervalued businesses, they go in, they figure out what wasn't working, they fix it, and they sell it for a much higher profit. That's what private equity is. You also have cryptocurrencies, and we did a video on cryptocurrencies, I think, so I won't touch too much on that right now. I will say that I think they're going up, but you have to follow the 4-year cycles, and when they go up a lot. When they go down a lot, and they could stay down a lot for many years. So do your own research and due diligence on that. And lastly, we have the derivatives market, and the derivatives market is all about owning contracts, right? So this is like when you hear someone say, like, I'm going long on a company, I'm going short on a company. They're buying a put, they're buying a call. What it is usually is people who are paying a small premium for the right to hold 100 shares of a particular company. And usually it's not for that long a period of time. It could be for weeks, months, or even years, but not typically. But it's because it's cheaper to do this than actually buying 100 shares of the company. If you think the company is going to move really quick, really soon, then you buy a call, meaning you have the right to own 100 shares of the company, and you pay a premium for that. And when the company goes up, let's say $1 per share, right? Well, you own 100 shares of that company, or you have the right to own it. So you just made $100 really quick. The problem is that you could lose money really quick. So this is something that you need to practice. You need to watch videos on how to trade futures, trade derivatives, trade options. You need to watch videos specifically on that. This is not the video for that, but this is a video to get your feet wet a little bit. So that is all I have for you today. I love making this video for you guys. You guys are the best. I want you to drop a like, drop a comment, share this video, and I hope to see you again on the next episode. But again, I love doing these videos with you. If you have any comments, if you have any questions, right, I will answer them as soon as I can, ASAP. So leave that information, any comments, questions, whatever. Take care, one and all. Love you all. Peace.